I'm going to be going in depth into this latest multifamily meltdown that we've seen in 2023, and it looks like it's going to continue into 2024. Now, why does multifamily not make sense? To take a very con approach to this and go through all the issues. Of course, it's not all doom and gloom. We'll show some of the positive outcomes out of this. And maybe now in the specific deals out there, it makes a lot of sense to enter the market at this point. But let's cut to the chase. Buying apartment complexes right now doesn't quite add up. When you look at the current cap rates, the math just isn't there. We're talking about a 5% cap rate on average. Now, if you have a property that's a little bit lower class, such as a B class, C class, in a more secondary, tertiary market, you may be talking more about the 7% plus range. But we're just talking about things in general, a lot higher cap rates today. Now, if you're unfamiliar with this, check out my past quarterly report when we went in depth over the whole equation where you take the net operating income divided by the cap rate in the market, and that's where you get the property value from. It's a pretty simple equation, but a lot of new real estate investors don't quite understand this concept. But basically, when your prevailing cap rates go up, say from 4% to 6%, the prices of properties that you're getting, even if it's performing at the same level, is going down. And that's ignoring the debt and other headaches that are plaguing the market today. Now, we talk about this in the podcast on a weekly basis. From a real high level, for those of you guys who don't know us, I'm going to dive into why this is such a big deal, especially with the options out there like US Treasuries, T-bills, and savings account, which right now are offering pretty dang good returns, 4 to 5%, without the tax benefits that real estate does. If you guys are interested in those tax benefits, especially for the higher income earners, check out our info page at thewealthelevator.com/tax. But why bother working with multifamily? There are other simpler ways to invest and have your money work for you. Now, the first thing to point out, rent growth is a little soft. And this is coming off the heels of 2020, 2021, where in some markets such as Phoenix, Arizona, we saw rents go up 20% year over year growth. We saw people renting for $1,000 a month and seeing that their rent turn around the next day is 12,500. Now, the 2024 is looking rough for rent growth. With a record number of units hitting the market, we're starting to see down the barrel of potentially significant rent stagnation, especially in hot markets such as Texas and Florida, which saw great rent increases. Again, this is a lot to do with supply. So you're having a lot of new inventory that was being built over the last few years because it normally takes 2 or 3 years to build one of these developments. We also develop ourselves. And yeah, I can truly say that it does take all of 2 years, even if you expedite things along. So what happened was in 2020, 2021, it was a great time to develop, right? You had a lot of good lending, cheap money, and a lot of people went and built, we ourselves included. And now you're seeing a lot of that hit the market, which is competing with a lot of your class B and class C material out there. The second wrench in all this is expenses. And this is coming out of your monthly P&Ls. Now let's talk about this a little bit if you're unfamiliar with. So property taxes, insurance, you name it, it's going up. And that's inflation. We saw inflation hit almost double digits last year. And this is how it's running up. And we're seeing it eat into profits big time. We have properties in Texas, and we've seen a lot of those property taxes maybe triple there, and a lot of our insurance has doubled. We used to own properties in Mississippi, in the Gulf, near the coastline. We don't own properties there because for one of the reasons we sold them is we're seeing those insurance quotes go up 3 times or more there. And in some places, some operators out there can't even get traditional insurance protecting against these types of hazards. Now, the third thing here, interest rates. Now, although we, at this point, February 2024, I think it's safe to say that we are seeing a light at the end of the tunnel in terms of interest rates. The best information that I have is the Chatham Financial page or the CMG forecast page. And they're saying that we're going to start to see the first rate decreases in this summertime. Now, it's going to be very slow, a quarter point, maybe a half a point at a time, but it's going to take at least 3 or 4 of these decreases to get back into the 4% range, where I think at that point, we'll start to see the buyers come back into the market. Anecdotally, I'm a buyer of real estate myself. I'm not just one of these economists out there, as you guys know. I've got skin in the game. And we haven't really bought anything since the summer of 2002 exactly for these reasons, because I can't make the numbers work. Now, even if I'm getting a property at a discount of 30, maybe even 40% of what it was a couple of years ago, part of this has to do with the federal interest rates where they're at. I don't have the leverage. I can't really make the deal pencil, which is why I haven't really bought anything for almost a couple of years now. Now, maybe when the Fed interest rates come back into the fours or the low fours, maybe I might return back to the market as a buyer, and maybe that might be indicative of the other players out there. And that will make cap rates come back down, which means that the prices will go back up to what they used to be. I'm saying don't hold your breath yet until we see a few of these cuts. We're not seeing a scenario where borrowing costs drop enough to make a difference. If anything, we see rates climb in the 10-year treasury yield rises, making borrowing even pricier. So what now? With the multifamily sector looking shaky, what are we going to do? I'd say single family and small multifamily properties, less competition, and fixed rate financing makes a little bit safer bet. A lot of investors out there, especially the ones that we work with, a net worth of $1 to $2 million or greater, buying little rental properties just is a lot of pain and agony. And you have the properties in your own name. So if somebody trips and falls, the liabilities in your name. And a lot of our investors just aren't feeling comfortable putting the debt in their own name. They rather be in a large syndication and private placement where the general partners are putting the debt in their name as the loan guarantors and taking out all the asset management and management headaches with that. Now, again, all I'm telling here is real high level stuff. What we may see is deals here or there with specific unique situations with the owner and a situation where they may be on the negotiating table with the bank. And what these are called are loan modification situations where an investment firm such as us might get involved at that point to bail them out, but they take over the upside in terms of the equity. Now, these are very unique situations, and some people call this sort of pre-foreclosure. You're getting it before the property gets put for auction or goes up for foreclosure. And at that point, the property really starts to decay and gets dilapidated at that point. Ideally, we would like to pick up properties before it hits that point, and obviously getting the nice discount on the situation due to distressed sellers. Now, I'm going to record a separate video where we talk about a lot of the reasons why now is the time to get into the market. But I want to bring this back to you out there. A lot of you guys are under $4 to $5 million net worth, and you haven't hit what I call end game yet. You're in your wealth building years or your growth years where you need your money to be working, and you need to be leaning into this uncertainty and fear, which is very high right now. But you have to find your own comfort level that you can stomach. Now, real estate has been my elevator to wealth, but I believe you need to find and mix it up with other investments that have value add opportunities or situations like we're talking about the loan modification type of deal. It's not just about getting away from traditional investments where there's high fees. It's about finding those with tax benefits and potentially higher returns here. Now, I get it. In times of uncertainty right now, it's tempting to pay off debt, whether you're going to pay off your house or put money in a T-bill or an online savings account, make 4% there. But remember your mindset during the good times. This is when you could make significant gains if you're positioned right. Don't limit yourself to just paying off debt funding. There are other options. And this is where some of our even more conservative investors who hit end game, they find this as a great opportunity to fund their infinite banking plan or start an accredited investor banking plan where they privatize their own bank. If you want access to this free e-course, you can go to thewealthelevator.com/bank, put your email address in there, and you can get access to our members portal with that free educational content. Again, take a look at that second part of this video that I'm going to record, talking about some of the pros and ways and taking advantage of this market. But I'll leave you with this quote from a recent Blackstone earnings statement in early 2024. I'm going to read it here just so I don't mess it up. But Blackstone said, I think it's about momentum. After investors have taken losses, even if they're modest losses, there tends to be caution. Real estate, because of the lag on when challenges materialize, will have a number of negative headlines coming out over the course of the year. Investors tend to take their time in terms of pivoting back to the space. That's certainly what happened in the early 90s. That's what's happened in 08, 09. And so there's caution. What happens is the recovery. First, you get this sort of bottom effect. Then you start to get some growth in values. and then the consensus starts to change. What happens in this period of time is you tend to get the greatest opportunities for investing because you can see the light at the end of the tunnel, but capital hasn't flown into the space. And that's the point that we're talking about today, guys. The professional investors, Blackstone, they are coming in at this point, and this is what we are also doing too. We're eyeing specific opportunities and going in, even though the consensus hasn't hit yet. But if you're somebody who still has more than 80% of your net worth not in alternative investments in the 401ks and the stock market, check out the link below where I talk about and I break down the spikes in interest rates and where the recessions fell on that graph there. And I think it's a pretty obvious that, hey, interest rates are high. We're going to start to see that recession and that stock market tank here in the next year. So even from that perspective, if you think real estate is a bit of a flat line, I think it would be prudent to take some money off of the traditional investment side and into some of these more non-correlated assets. But with that, if you guys have any questions, put it in the comments below and then check out that second part of this video where I sum this up and what to do. And if you guys like these types of videos, let us know. And also join our community at thewealthelevator.com/club. See you guys later. Bye.